All right, Michael, what's up? Welcome to this special outdoor eco version. Eco version. I don't think version's the right word, but you know what I'm saying. Uh, of the Opex monthly Opex discussion. Thank you all for joining us here today. There's a lot of interesting stuff happening in the volatility space, so we're going to cover that. As you can tell, I am operating off of a laptop as I am on the road, and so the presentation will be a little bit different today, but hopefully we get all of the information across. So thumbs up, hopefully you can hear me, and we can get started over here. Um, all right, so the big thing that we've been trying to highlight here is that sure we get the right camera loaded up in there. Sweet. All right, we got it. um, S&P obviously starting off a little bit weak, and I think the argument that a lot of people have been trying to make over the last couple of days here is obviously this kind of well-known window of weakness that people tend to assign or associate with VIX expiration to equity expiration. And so obviously VIX expiration was yesterday morning, and we have OPEX here tomorrow. And so the historical argument is that, look, we have these positions that have been associated with a strong market rally. And then when those positions expire or start to shift, that allows for equities to start to move. And my argument was that, look, this is not a particularly large expiration. And so I'm not necessarily in agreement with this window of weakness. And I'm saying, hey, look, Nvidia to me is arguably maybe the bigger event. And I have a couple of reasons for that. Now, of course, as I say that, we look at the equity space here today. You can see here on the HIRO indicator that the market opened sharply lower. We're down about 1% roughly, as you can see up here. And this purple line going down is telling us that traders have started off today uh, buying puts and or selling calls. You can see when the blue line, sorry about that, when the blue line is going lower, we are seeing put buyers come in. And when that orange line is going lower, that is call sellers coming in. And so if I just scroll over here a little bit, you can see down goes the puts and calls being sold. And now around this 6,100 level, we're seeing a little bit of bounce now in the HIRO indicator, which is suggesting that, okay, all those puts and calls that were puts bought, calls sold, that's kind of being covered a little bit. And let's just take one more quick look to see if this is longer term duration. We'll get into it. So this is interesting. When you look at this and you look at the separation between the lines here this morning, teal is 0 DTE only positions, purple is all expiration options. And so this flow that came in this morning is a little bit longer dated in nature. It's not the 0 DTE crew coming in. So for bears, that is a little bit of a positive development, positive for bears, negative for the market overall, but you get what I'm saying. So anyways, that's how this is looking this morning. The VIX is obviously perking up a little bit. So let's dive into exactly what we see is happening. For those of you who don't know, two things I want to mention. Number one, if you go to spotgamma.com/OPEX, we have an OPEX spreadsheet where we detail the names with the biggest amount of positions set to expire tomorrow. Pop in your email and we'll send you over that spreadsheet. There's a lot of cool information in there that can help you identify which names may be most moved by expiration. Now, the second thing that I wanted to share was this presentation. This is a presentation I do with my friend Jack from Excess Returns, where we cover a bunch of in depth the volatility space and positions into expiration. And so as I get up to where I want to share, this chart is what I wanted to share. This is our fancy new OPEX graphic. And number one, what you see here is the S&P 500 dominates the expiration space, right? It is bigger. This is spiders and SPX. It's bigger than single stocks, ETFs, and index. So it's NASDAQ, Russell, VIX combined. And that's typically how it is. That's not abnormal. You can also see that there's a real call weighting here when we look at deltas. And generally what that tells you or what that informs you of is, look, if we built up all these call positions, it makes sense that we'd have a little bit of a sell-off or a correction after those positions, after that expiration. And in fact, if you look at the statistics, what you see here is that when VIX expiration occurs after options expiration, that is not what happened here. But when that happens, 68% of the time we reverse. So what does that mean? Equity market rallies into OPEX, it sells off after. Or equity market sells off into Opex, we bounce after, right? So 2/3 of the time, a little better than 2/3 of the time, that occurs after VIX expiration, when VIX expiration is after. In this case, we have said VIX expiration yesterday, Opex is tomorrow, equity Opex, and so it's still better than 50-50 chance that we reverse, but as you can see, those odds are not quite as strong. Now, it's also, it feels to me and it seems to me that with the kind of invention of zero DTE, and that's 55% now of S&P volume, that these dynamics have changed a little bit. Obviously, people understand the Opex cycle is a little bit better now. And so, these statistics and sort of the positioning impacts is a little bit fluid. I think still when you get a really stretched position, either in a single stock or in the S&P, when you really stretch it high into Opex or you pull that down and call values or put values are really massive, you still get that bounce effect, right? But again, this is not a massive expiration. And to put this into context a little bit, this is the size of single stock positions for February Opex. You can see that March expiration, which is the quarterly expiration, is a lot bigger. This is smaller than the January options expiration as well. And so that led me to say, hey, look, I don't think that this is a massive options expiration. So I'm reducing the impact or my view of the size of this expiration a little bit. So let's kind of take that and then let's step into what I think is the more interesting piece. And this is on the volatility dynamics. Because I think this is where, the real signal is. And the TLDR here is that volatility right now is very low. You see VIX 16, but that is not really telling you, in my view, the story. I wrote this morning in today's founder's note about what I thought was stabilizing gamma in the 6100 to 6200 area. Obviously, we're breaking a little bit below that right now. But what I want to dig into is the volatility dynamics. So what you see on your screen here, again, we talked about this in the founder's note, this is term structure. So if we go to the volatility dashboard here, we could take a look at the S&P term structure. And what you are generally seeing here, the vols are lifting a little bit this morning because of some of this risk-off sentiment. And I think some of this risk-off sentiment, I just want to say, is driven by Trump coming out and saying, hey, I'm going to cut defense spending. And so, well, Brent, who cares necessarily about that? It's kind of like a tariff. But look at Palantir, right? Palantir has gotten absolutely, I think drop kicked is the word, right? This stock was just screaming. It's kind of it's been the kind of a poster child of excess sentiment, I guess I would put it. And so now you are seeing, this is all just paying the piper, right? And this gets into another dynamic I want to discuss shortly here, and this is kind of like overreactions to news. But Trump obviously came out, and this is the risk of this current regime, right? Is the Trump headlines. Trump comes out, says tariffs, market dives. DeepSeek news, market dives, right? So let's just here are the returns since Jan Opex, right? We had this massive rally after June Opex, and then we had 2-3% decline. 3% decline, 2% decline off of tariff and DeepSeek headlines, right? So there are these liquidity holes that generate these giant drawdowns, but there's no volatility premium being added, even though we've had this, what I would associate or what I would call jump risk, right? So let's get back to the point here, Brent. So this morning vols are up a little bit, but when you look at this and you're talking about, at the money vols right now in the S&P, 10%, right? These were 9% this morning. Or last night. This is, as you can see by this cone, these are statistical lows. And as I laid out in the founder's note this morning, you have to go back to early December, pre-Powell and VIX expiration in December to say, hey, when were vols lower? And so these are, as we all know, there is a lower bound in volatility. It can't go to zero, right? The market is going to move something. And as we all know here, the all-time low in realized vol was October of 2017, where realized vols hit 3.5. Right now, 1 month vol, realized vol in the S&P is about a 10, and 5-day vol is a 7. You can get down in the 5%, but that's really the lower bound. So, we're pressing this lower bound. Now, just because vol is low doesn't mean it have to spike, but we're in this regime now where Trump will tweet, a headline comes across, whatever it is, and then suddenly we get this big, volatility jump, right? So there is a lot of jump risk in this market, and it's not really being priced in. So point is, these vols are actually, really quite low. Again, you have to go back to early December to find this pocket of kind of abnormal volatility. And you can look at the VIX in this, but we also like to look at the volley indicator. Volley index shows at the money spider implied vols. And so this is what I'm talking about here, right? This is, and you can go back in time and you can see, right? So we stretch this all the way back. That December pocket of really low vols outside of late June, early July of this year, excuse me, of 2024, you're talking about post, you have to go back before COVID to see lows and at the money vols, right? That match those levels. And the reason that this is interesting to me is because you say, hey, look, there's a little bit more vol to squeeze here if we want to go back to that early December, you know, ultra low vols, right? Or if you want to kind of go back to the June, July ultra low vols. Well, what was happening in July? In July, we had Nvidia AI mania, right? Everybody was falling over themselves to get into Nvidia. And if you go back and look at our Opex effect or this recording of July Opex and June Opex, we're flagging, the incredible oddities in those markets, right? Correlation at record lows, longest number of days without a 2% move in the market, record breadth, right? Narrow breadth, just a few stocks were everything. And so, that was one part of the period. Then the second period was Trump got elected, vol gets squeezed. Everyone's like, this is great. We're expecting whatever it is, 10 rate cuts or something. And Powell comes out and says, guess what? Nope. And then suddenly vol jumps, right? VIX expiration and FOMCs on the same day. Vol jumps, and we have not gone back to that same level. And while I'm not a macro man, it seems to me now that we are trying to figure out, hey, like, is inflation sticky? Is Trump going to make it worse? What's going on? There's a lot more uncertainty now than there was obviously heading into that FOMC in December. So vols, in my view, shouldn't go back to this same level. So Brent, what is your point? Get to the point, Brent, right? You have a small chance here where I think if Nvidia earnings are really good and positive and they say DeepSeek means nothing, that we could kind of board that AI train and maybe we squish vols a little bit lower, and that could be a really nice 1% to 2% kind of rally, maybe even a little bit more in top single stocks. So that's the short term, kind of Goldilocks scenario, right? When you zoom out a little bit and you say, hey, I'm not a day trader, I just want to take the bigger picture. This is all setting up for, we're at a lower bound in vols and we're likely to see some kind of material vol spike, I think, in the next 1 to 2 months. And you say, hey, Brent, 1 to 2 months, that's like, it's quite a amount of time. Like, you're basically trying to ride both sides, right? Like, hey, we'll rally, hey, we're soft. Well, look, if Nvidia is good and Nvidia's on the 26th, then that could be the juice, right? That gives us a final squeeze and we still drop, right? So I don't think that there's a scenario out there where we don't see some type, and it doesn't have to be a VIX 40 or VIX 60 like we had in August, as you can see here, right? But it can be a pretty material spike, up towards that 20 area. And so what we were talking about this morning is like, look, in these scenarios, you just go, downside protection seems pretty cheap. There's a lot coming up. Maybe Nvidia earnings are bad. There's the debt ceiling news. There's, just a tweet, whatever it is, that could easily pop these vols. And as we see with Palantir this morning, we have these liquidity holes. And yes, the liquidity holes that was generated by Nvidia, for example, dropping largest market cap drop ever, right, just a couple weeks ago, those don't catch, meaning there's no persistence to them. It's like autocorrelation kind of doesn't really exist on down days. There's no follow through at all. And I think we're like one headline, one little scare away from that persisting. And then what happens in that event is that is when you get the VIX spiking materially, right? Think about what happened in August of 2024, right? Largest, VIX spike, certainly post-COVID era, maybe even longer. This is correlation. And what correlation is showing us is the price of implied vols in the top 50 U.S. stocks versus the S&P vols. And so the way you can think about this is that when this indicator is at its lows, that's telling us that we're in very bullish territory, right? People are bidding up single stocks. People are selling S&P vol. There's very little risk in the market. At least that's how it's perceived. And we're generally riding high. So how does extreme lows and correlation normalize while we have a crash, right? Because when we crash, people sell all stocks, right? Plow out of single stocks, plow out of index vol, plow out of single stocks, sell off the S&P 500, and all those vols spike. So why am I focused on this? Um, you can go back pre-COVID, right? And here is 2017. Again, as we know, this was like the aberration in the volatility market was late 2017, and it was those lows in vol, right, that led to Volmageddon in January of 2018, right? That's what you saw. So when we fast forward here in 2024, brought fresh lows in the volatility space, right, or in this correlation metric. Look at July, right? It broke these lows, as you can see on here. And so this was Nvidia going crazy, everything else. It was a wild market. Again, we highlighted all these aberrations in our Opex videos, and this is what sets the stage for VIX popping over 60. And yeah, you want to argue it wasn't real, whatever, fine. VIX printed at over 60. You wouldn't get that poor liquidity. Sorry, I almost said improper word. You wouldn't get that kind of poor liquidity and the opportunity for VIX to be mismarked unless there was just these really bizarre, this bizarre stretch setup into it, right? So it's like a slingshot. We had to get the extreme, exaggerated positioning in order to set up that August freakout. And then, as we all know, on the morning of August 5th of VIX 60, everyone's trying to look back in time and say, oh yeah, here's the narrative I need to. It's the yen trade. The yen trade was just kind of the excuse to finish off this positioning, right? So again, if we kind of forward to where we are now, you're like, okay, Brent, like get to the point. I'm getting there. When we look at this positioning now, we could see that correlation in early Feb kind of broke this 2017 low. 2017 low is just this barometer from when we know vol was at like all-time lows, right? And so, it's kind of funny to me that we pull this back a little bit, and then what happens into that weekend, that's the DeepSeek news, right? And then all of a sudden we get this big nasty drawdown. So we got low again in earlier this week, late this week. We're still kind of skipping along these bottoms, and you may say, hey, this is due to earnings, right? That correlation is off, or correlation is low. And I say, okay, fine. You have Google, Apple, Microsoft all already reported. Now we only have Nvidia left to report. So you can't say, hey, the low correlation early this week is due to that. It was more due to what I think was kind of this bullish positioning and a lack of response to vols. And so, again, the risk here is that, and I'm talking about, I don't know what the trigger will be or if it'll come, but if you start to look at 2, 3 to 6 month puts or VIX calls, you start to say, hey, maybe I just need to own some of this protection because we're setting up for this, things to start to make sense again. Because right now you could argue they don't make a ton of sense. Let's just talk about some of the lack of response that we're seeing here. We had highlighted VIX expiration, that it wasn't a huge expiration in our view, and that a lot of dealer short positions were coming off. We sent this out. I produced this video with Jack. Next day, we know these giant VIX call buyers came in, and Omura put out this very extensive note about there being more Vega now than they've ever seen before. And if we go to yesterday's founder's note, I included that chart so you get a view on that. And so what this is telling us, and what we wrote about here, is like, look, Vega, the Vega sitting here is convexity, downside convexity in the market. What does that mean? It means that it's like a turbocharger. Those of you who know about turbochargers in cars, it's like if you're just going 1 mile an hour, the turbocharger doesn't do anything, but you hit that gas and things start to spool up, then that turbocharger kicks in, right? And it's kind of the same thing here. It's like if you push the equity market down a little bit and vol just kind of warms up, it may not catch. But if you get VIX over 20, then this Vega adds convexity to the market, which could really add kind of downside risk, right? So this is the kind of stuff where you go, okay, like it takes an August sell-off where it's like, okay, VIX 1820, and then we kind of get this yen carry trade unwind that suddenly VIX goes crazy, right? Because you just hit this convexity where also news matters more. So that is that's kind of the backdrop here. Now, if you look at put positioning, if I forward way through here, sorry for, excuse me, having to scroll like this. If we look at current put positioning here, this is what we currently have. This is our trace back model for those of you who know about trace. And in trace, we're tracking whether we see dealers long or short various puts and calls, right? And so when we look at current positioning, dealers have long call positions, so positive gamma up into the 6,200 area. The JP Morgan call we all talk about is right around the 6,150 area. But look at this downside, right? They lose their deltas into just under 5,900 in that general area, but there's not a lot of downside put convexity, I would argue, until you get under 5,500, right? So if you think about this, when dealers have positive deltas, they need to hedge those deltas to the downside by selling futures. And so if this curve started closer to 5,900, you say, oh, there's real risk. But I also think this is interesting because we know that in the last several drawdowns, right, the equity market seems to have gone from 6,100 right to 5,950 and then just stop going down in that general area. So if we kind of look at the drawdowns here over the last couple of weeks, you can see that, right? You can see right in this area, we seem to find support. And it's interesting because that fits with this dealer positioning sort of bottoming out where, okay, we're losing positive deltas from call positions, but there's not a lot of puts going down, meaning that while there is a lot of this Vega and convexity risk as per Nomura, there's not a lot of big short put positions. Tails maybe, but this isn't that kind of situation where you go, hey, a lot of puts sitting here waiting to be kind of provoked. And so I would want to see more put positions here to think that this is extremely risky on the S&P side, but you do get some of that risk in the volatility space, in the VIX side. Now, if we look at this is equity vol premium. So what we're looking at here is realized vol, implied vol versus realized vol on a 1 month basis. And as you can see here, there's very little volatility premium. Now, this is surprising me again, given the shocks that we've had recently, right? Again, DeepSeek tariff headlines. We just had argument in our tariff headline here, kind of sort of like tariff with the budget cuts, defensive spending budget cuts, and the drawdown there. So you would think that in this environment with the regime change politically, that there would be a little bit more of a vol premium, and they're just not. And again, we look at correlation here at these lows. And so you can just see we're at the bottoms of vol, and vol can stay low, but you get one trigger, one sort of persistent, oh, we're actually going to stick, or the argument or the negotiations on the tariffs aren't going well, or inflation is hot, whatever it is, right? Then suddenly you got a real drawdown. And I was talking to Jack on our Opex podcast about this too. This idea of liquidity holes. And we made this, if you go back, you look at another one of our videos, we called it the Nvidia Industrial Complex. And the idea here is that you have massive options complexes in these top names, right? Nvidia, Tesla, Apple, et cetera, Microsoft, Amazon, et cetera. You have giant levered ETFs. The Nvidia 2X levered ETF will get up to be, $5 billion. Often we were constantly, I don't know what the appropriate word is. I don't say making fun of, but just railing on MicroStrategy as that levered ETF spooled up, right? And people are saying, I'm selling. I forget what someone's like buying Broncos with cars with MicroStrategy dividends or whatever. Anyways, so you see these levered ETFs really build up. Now the argument is that look, you have huge stock buybacks in these Nvidia in these mega cap stocks, right? That removes tradable float. These ETFs removes tradable floats, and I also make the argument that dealer hedging flows removes the tradable float. So when you get big news, you get bigger jumps, you get more vol. Like the vol of vol is much higher, and so now what you have is DeepSeek news comes out, and people go, I don't know what to think about this DeepSeek news, but Nvidia stock is down 20% in one day. Third largest market cap stock in the world can drop 20% in a single day. Well, that must mean that DeepSeek is the most important thing that has ever happened in the history of computing, right? I don't know for sure if that's true or not. I don't think it is, but you get the stock reacting. And as I've been saying, it used to be, hey, the reaction to the news is more important than the news itself. And so when you see the reaction, you go, oh my gosh, this is hugely important. And it turns out it's like mildly important. I mean, maybe it's important, but it's not imminently this threat. We'll find out more obviously in a couple of days. But when people see the stock down 20%, they think it's really, really bad. And the reason that the stock is down 20%, I argue, is because of all of this leverage. And so you get these exaggerated moves. Now, I would think most of you listening on this call, if I said, hey, Nvidia today, if I just told you this, Nvidia today is down 22%. It is the largest single day market cap decline in the history of the US stock market. What would you think would have happened to the S&P? You would think it'd be down a lot. And you would also say, if I was to say, what do you think would happen? Stock market would be 3 to 5 days from that point. I think a lot of you would probably say down, or at least there would be some kind of a shock. Well, as we all know, there wasn't, right? S&P was down 2% that day. Dow was flat, maybe down at most 1%. And within a week, all that had recovered. So that backs this idea that it's really leverage that is exacerbating these moves. And again, when you look at Palantir, it's a really similar situation. Not only to the upside, not only to the downside, but it's similar to the upside, right? You're getting this ridiculously stretched move to the upside, and then that's the famous thing, right? Escalator up, elevator down. You're getting these reactions, and so there's a lot of leverage in this system. It's creating these jumps, and to me, there's a lot of risk embedded in it because you get one of these jumps that sticks, right, and it falls through. Okay, Brent, what's your point? Tesla, after the election was up 50%, as you can see here, from its December 18th high when Powell came out and said, guess what? Rates are not going lower in the near term. It's down 50%. In February alone, the stock was down 30%, right? In the first 2 weeks of February, it's down 30%. This is the number 7 in the S&P, 7th weighting. So what happens when you actually look at vols in Nvidia and Tesla? This right here, it's hard to see, I apologize. This vol spike right here is when Nvidia lost 20%, largest market cap ever. Hard to identify exactly that volatility drop, as you can see here, right? Didn't even take out the July volatility spike or a vol spike, kind of stock up, vol spike from March of last year. You certainly wouldn't look at this vol chart, I would argue, and say, oh my gosh, that's where the stock dropped 20%. Pretty hard to identify. So if people were really worried that Nvidia was dead, right, and longer dated investors came out and said, I got to start buying puts here, this thing is in trouble, then you would think that vol would spike. Instead, what happened is people are really selling calls, right? So people buy calls to play the upside. When they think the upside is done, they sell those calls or they short those calls. And so what you get is volatility not really responding. That's not a fear-based signal. Like when you say, hey, I don't think the stock is going to go up anymore, so I'm going to sell my calls either short or I'm going to sell the ones I have long. That's a totally different outlook than saying I need to buy puts because I think this thing's going to drop. Now, what about Tesla? This is the most incredible vol up chart I've seen, at least in recent, since 2021 maybe, where again, Trump gets elected. There's, we wrote a lot of articles about this. People just chased into this thing. They bought calls, stock rips. But then look, this stock lost 30% in the first 2 weeks of February. Look at vol. Just comes sliding on down. So if Tesla's going to go out of business or whatever is going to happen, you think, hey, we're going to buy some puts. Not occurring. What we're seeing here is, again, vol coming down with the stock going down. So the other part of this that is interesting is that when you sell calls and the stock goes down or the market goes down, those call values go to zero, and any kind of related hedging obligations or volatility spikes kind of dry up, right? Because there's, in our view at least, there's no dealer hedging flow associated with that. If people buy puts, as the stock drops, those put values expand and volatility increases, implied volatility increases, making this more downside push from the market making or dealer hedging flows. Now, there's a small amount of vol spike here in Nvidia, not huge. There's no vol spike whatsoever in Tesla at this point. And so, when you look at this, you would not think that these stocks are having these dramatic drawdowns. And then the second part of this is that you would think that at the money implied vols would just start to increase as a function of the stock, as a function of the fact that these vols are increasing so much, right? Meaning when you get realized vol, you would think that you would get more implied vol, right? Because the stocks are moving so much, but it's really not, right? In other words, if I said, hey, Tesla's going to start moving with a realized volatility level of 60%, well, I need to start betting that we're going to move 70% in the future because I need a little bit of event premium or forward premium. Um, but you're just not really getting that. So this really syncs up to me with the lack of volatility response that we see in the S&P 500 overall. And again, in the short term, it's like this Goldilocks thing where it's like, okay, maybe we get one little final squeeze, things are all right. We get that little vol pop, that final little contraction, particularly if Nvidia news is good. But when you start to zoom out, it looks and feels a lot like that moment from kind of July where you go, this stuff is not making a whole lot of sense. This stuff seems too cheap, or even kind of early December, you go like, this is all just not making a ton of sense. And we kind of get maybe that one sticky headline or one sticky piece of bad news. Maybe it's a rate event or something like that. And then we start to get a pretty quick, protracted drawdown. It's hard to see a scenario where, like in December, where we just had that unbelievable volatility drop. I forget the statistics around that, but I know when Powell spooked the markets there in late December, it was a very significant drawdown in terms of its magnitude and velocity, right? And so you start to look at this kind of a thing, or even in August, late July kind of thing, where you just have these really sharp move, and that move could get maybe a little too accelerated to the downside because of these liquidity dynamics and the lack of volatility that we're seeing in the markets now. So, when I look at this and I'm positioned about on February 11th, we said, hey, calls seem really cheap in the S&P, and we were talking about 6,200 area calls. Those calls are now kind of early March. Whether or not that plays out, again, I think is going to be driven by Nvidia, right? I'm sticking with that view, even though we had this kind of drop, nice bounce here back over 6,100 for the moment. But the longer term view or the longer term positioning, I think, is like, look, it makes a lot of sense, even if I'm not saying you should dump all of your longs here, but it makes a lot of sense to start to think about owning some longer dated put protection with the idea that I don't know what the event will be. I don't know what the trigger will be. But if there is one, then owning some type of downside protection or VIX call protection, that kind of thing, could start to make a lot of sense. And the reason that this comes up now is because I do think if Nvidia news is bad, then you start to get the offset effects of that, right? Nvidia may say, hey, tariffs are causing us problems, DeepSeek's causing us problems. Then you lose the chip sector that really impacts the NASDAQ, and that could really be a little bit of that trigger. So that was a lot. No, I probably spoke very quickly through there. Let me see if I can pull up some of the questions that there are in your chat. Matthew, that's right, outdoorsy Brent. Yeah, Michael, the trigger for cutting government spending could certainly be one. Increasing taxes. I mean, there's a lot of stuff on the macro side that could cause problems. And again, I'm not a macro guy. I don't envy guys that have to track that macro stuff. But the point is here that there are times where we're not talking about rates. Nobody really cares, right? And I think from July, when Powell first said, okay, we're done hiking, to December, when everyone thought there was more cuts coming, rates kind of took a back door, or inflation kind of like side issue, right? Certainly after Powell in December, that picked up. And then CPI was hot, right? What happened? Market drops 1%. And then just like rips. It was like the bad news isn't catching, and maybe that's some hope in the things that Trump's doing. I don't know. I'm sure just saying that kind of thing gets everybody spiked here. Travis, I'm not in Yosemite. Well, close. All right, light on the questions today, no problem. So that is the crux of the presentation here. Those are those are the dynamics that we're seeing into this Opex. Now, the reason we're talking about a lot of this right now is because a lot of people do assign, again, Opex with this window of weakness. If you go to spotgamma.com/Opex, you can grab our Opex spreadsheet, and you can see which names indeed have the biggest options positioning. So please check that out. But the thing that I'm kind of, I guess, here to say is that I think it's more the Nvidia that will be the spark on Wednesday. Now, as I'm saying that, I've been saying that, obviously there's this weakness this morning off the Trump headlines, which again sort of just highlights that kind of underlying risk in this market, right? I think people are starting to kind of the K function of the tariff tweets or whatever. And people go, okay, this is a negotiation tactic. It's not that it's actually coming. Well, you're always just a little like 25 degrees away from something being real. If it is, then I think you really see that drop and that drawdown that sticks. Right, and that's what the risk is, and that's why I think it makes some sense to own more put spreads than puts. And the reason you want to think more about put spreads is because even though vols are low, this is an important dynamic. If we look at, I like to look at the SDEX, which is the nation's skew index. Skew is lifting a little bit. Now, what does this mean? It means that the overall rate of vol is low, but the put values, the out of the money put values, remember in our chart before we showed put positioning, that kind of downside stuff is starting to get a little bit of a bid. So there's a little more convexity in the put side. So overall, the vol surface is low, or vols generally are low, but that put tail is starting to get a little bit of a bid, and so I think put spreads in that case make sense because you can hopefully sell that expensive long, farther out of the money put versus a more not necessarily at the money put, but maybe like a 25 delta versus a 75 delta, depending on how far on time you're going. That kind of a rough idea. All right, looks like we are all quiet on the question front. No problem there. So we are going to look to wrap this up. Again, if you please go to spotgamma.com/Opex, you can grab our Opex spreadsheet. If you do have any questions on SpotGamma or the platform itself, you can head over to spotgamma.com and try things out. We'll just give one quick last market update here before we move on and just see how the market is responding to this drawdown. So this is our trace application for those of you who might be new to this. If you see this bright kind of purple area, what this is suggesting is that there is a fair amount of long dealer gamma, which should be supportive of equity flows. What does that mean? Dealers should be buying the dip and selling kind of the rip, and that contracts equity vols. Now, if we look at all positioning, this is interesting because the positioning has shifted a little bit from this morning. So if we show you kind of 9 o'clock this morning, you can see that we had light positive gamma across all strikes, right? And then as soon as the market opened, we see that positive gamma disappear. And right now what we end up with is negative gamma strikes in this general area. Now, most of those are 0 DTE positions. And I could tell you that because if I toggle 0 DTE on, you can see these are all 0 DTE positions. And then up here is the JP Morgan strike. You can see it up here. So what this tells me is we have support at 6,100 because this is a fairly large strike. And there's nothing stopping the market from bouncing all the way up into the 6140 area. Now, playing devil's advocate, if we get down again into this low, right, you can see there's negative gamma down here and below. So, this is a market that today, right now, is poised to either respond back to 6150 in my view, or we could see a pretty nasty drop down to 6050. Obviously, based on the things I'm saying, I would think that we would bounce and kind of follow through. And one of the nice ways you can sort of assess that is to watch HIRO. And we can put HIRO on this map, but I'll show you just the HIRO flows in general to see how people are responding. Now, before we look at this, if you were going to be bearish, what you would say is, are people buying puts on the downside, or they continue to buy puts or sell calls as the market got weaker? Obviously, from the market bounce this morning, we know that's unlikely. And so if we start with looking at the S&P 500, what we see? We broke 6,100, and then there's a huge 0 DTE response. And the reason I say this is mainly 0 DTE is because, again, the purple line tracks all options flows. Teal tracks only 0 DTE. So even though longer dated put flows came in, we could tell because those lines separate, 0 DTE bought the dip. And this is a function of what you see all the time in market weakness is 0 DTE buyers come in and they buy the dip. And that, in my view, adds stability to the market. Here we can break down by puts and calls, and you can see the green line is 0 DTE calls. Those are bought. 0 DTE puts are sold, as we all know. Nothing, people don't like selling anything more than short-dated puts. And so we got the initial bounce here, and the key will be, do these flows persist or do they roll over? And so as we're on this 6,100 kind of pivotal line, what you want to see is call buyers continuing to come in, or at least people not looking, possibly selling puts or buying calls. You don't want to see a situation where people are persistently buying those puts if you're an equity bull, right? So this is a real critical pivot point to watch these flows. On the single stock side, our equity indicator here shows you the flows in all the S&P 500 stocks. And so what you see here is off the open, negative delta flows till, again, we hit 6100 in the S&P, and then those flows shut off. So when you're thinking about Nvidia, Apple, Tesla, et cetera, that's what you're looking at here. And this is, again, what is interesting here, I would say, is that it is a lot of longer dated put buying and call selling in these top single stocks. But what's funny is right at 10 o'clock, that flow shuts off. And when I say it shuts off, you can see the lines go flat, right? So it gives kind of that programmatic, systematic kind of look, right? Because if everyone individually is out buying puts and selling calls, you wouldn't have such a clean, line where all this shuts off. So you start to think about a large fund or entity that's systematically trading, because they buy puts and sell calls, and then at 10 o'clock, like in Europe or whatever, they just stop, and then that flow just more or less kind of dies off. So, not a lot of follow through at this moment, which tells me, hey, look, if we just sit here and nothing happens, this little bit of vol premium that built up from this morning sell-off will come down, and then we could have a little bit of a rally. Last, let's just identify what stocks this morning are seeing the brunt of it. If we scroll up here, I like to sort this HIRO signal and see which names are selling off the hardest, and we'll get a look at Palantir as well on the single stock side, just because I know that's moving a lot and people are checking that out. So interesting. Goldman, Royal Caribbean Cruise Lines down a lot. If the left dot is all the way to the left, these are the names that have the most negative delta flow, right? Biggest call sellers and put buyers are in these names. So you can take a look at those names. Obviously, sometimes there's some interesting trading opportunities there. And then on the upside, China still having a lot of follow through. We can talk about those names quickly, with FXI and KWeb both doing really well. And that kind of thins out. Interesting UVXY catching quite a bit of bid, as well as TLT in there as well. You see VXX here, right? That's suggesting that there's some call buying and put selling in those individual products. So let's just take one quick look at Palantir and see what is happening. With that, I'm guessing it's a lot of call selling this morning. You can see 470 million of total deltas, negative deltas. The record is minus 587. So this is definitely a big negative day for Palantir, but not the biggest that we've seen in the last 30 days. And if we just break this down a little bit more, what I would expect to see, and this makes sense, is longer dated put buyers come in off that high, as well as orange is longer dated call sellers. So those flows are somewhat persistent here. This is not a zero DTE game as much. And that makes sense in the names where vol gets really stretched, right? In this case, it's stock up, vol up. And so if you get the more sophisticated traders, they're going to play in the volatility space in a little bit of a longer dated time frame, right? You can't quite capture that same vol kind of Vega, right, with zero DT or next expiration options, right? You can trade, obviously, big moves with those short dated options, and if they're cheaper, you can obviously get a lot of leverage that way. But if you're thinking, hey, I want to play implied vol contracting, then you're talking longer dated options. And Palantir, one of the cool things for those of you who are a little bit new to the platform was we added tape, and so what I can do here is I can go and I can look at the flow data here and see what big things are actually trading. So here you see the summary of the tape of what's been trading for Palantir. Now, if I go to this contract data, I can see what the biggest options are. A lot of February's, these are tomorrow's options. You can see the calls and puts for tomorrow's options are particularly big. The first set of contracts are all from a premium perspective and a delta perspective, in these in the money puts and calls that are trading. If you want to check and see what longer dated options might be more interesting, you see someone, for example, here, there's these big lots of 60 strike calls for next year trading, as well as some kind of end of February, end of March 100 strikes. There's a lot of Vega associated with those trades. So you see when you look at the Vega space, the expiration moves out a little bit, as we were just discussing. And then in just tape, we'll just wrap this up by seeing what the biggest trades are. I found this to be really interesting if you look at largest daily trades, because the sectors really switch and you get a flavor for what's happening, right? IWM, you can see that a lot of really big options trading here today. They could possibly have some type of an ETF role. I'm not entirely sure on that one, but that's the first thing that comes to mind when I see these really big IWM trades. It's pretty rare to see the largest trades in the day dominated by IWM. You really just generally don't see that. Big VIX call print that you can see there. We can check on what side that was. And then KWeb also showing up here quite a bit again. those Chinese options are getting, they're the prices are really elevated, but the good news keeps coming. And so, when you start to look at the skews there, they're just very high. And maybe this is kind of the rebirth of the Chinese, tech market. I suppose that's possible, but you can see here KWeb skews not super high. 76 is elevated, but it's not like nosebleed. Where if you look at like BABA, for example, uh, the BABA skew rank, um, it's come down actually a little bit. So 77, 78. When you start to get into the 90s on these stocks is when you start to say, okay, this is really quite overdone. Seems like it's coming down a little bit here for BABA, and so we love to use the skew rank as a navigation tool, right? Because um, when you get really high skews like we have in Baidu, it's telling us that call prices relative to puts are more expensive than they've been at any point over the last year. And so oftentimes that can really indicate this overbought scenario, right? And so those skews have come down a little bit recently, but still quite elevated in those Chinese names. So, all right, that's it for me. Again, please go to spotgamma.com/Opex if you want to check out the Opex spreadsheet. My view is still that we should see a little bit of a bounce here. That's what I think. I think we're waiting more on Nvidia earnings, although the market right now obviously is moving a little bit lower. I do like owning these slightly longer dated puts or VIX call options because I think that we do see kind of the vol market make a little bit more sense where these big jumps and drawdowns in the equity space that we've been seeing, they have some follow through, sort of multi-day drawdowns, and you start to get that kind of mid-December, maybe even late July type look where vol actually jumps, correlation spikes a little bit, and maybe things start to make a little bit more sense. So, all right, that's it for me. Thank you all very much for joining us. And for SpotGamma members, we will see you on Monday with our normal Q&As. Any questions, please email us info@spotgamma.com.